Good morning. Portfolio blanket loans, the pros and cons for real estate investors. And if you own multiple rental properties in Houston, Katy, Fulshire, or anywhere in Texas or this great nation, you've probably heard the term portfolio blanket loan. And it sounds efficient, it sounds scalable, but like most leverage strategy, it comes with trade offs. And as a mortgage broker and commercial financing advisor, I don't push products. I structure debt strategically. And let's break down exactly when a blanket mortgage works and when it can quietly increase your risk. So, what is a portfolio blanket loan? Well, a portfolio blanket loan is a single mortgage that covers multiple properties under one note. So, instead of five different separate loans and five separate closings and five separate maturities, you get one nice little clean package with one loan, with one payment, and one maturity date, and one underwriting process. And these are common for real estate investors with three or more rental properties. They're also common with BRRRR strategy operators, but also small multifamily investors. Think 1 to 4 units grouped together in a bigger loan. And investors refinancing scattered site portfolios. And how do blanket loans work? Well, a lender evaluates the entire portfolio's income, the expenses, and overall loan to value ratio. And underwriting is often based on your combined debt service coverage ratio, so your DSCR, but also the loan to value for the whole portfolio. And the borrower's liquidity and reserves are something that gets looked at. But also we have to look at exit strategy and how are you going to exit. And many portfolio loans are in the 3 to 10 year term variety. There's generally some interest-only options available, and they will typically have a balloon maturity structure. And sometimes prepayment penalties. In fact, most cases, prepayment penalties. But this is where strategy matters, is the point. So let's look at some pros of portfolio blanket loans. The thing that everybody likes the most is the simplicity. So you got one payment instead of juggling multiple lenders and maturity dates. And for investors scaling in Houston or West Texas markets, administrative efficiency matters. Two, it's got easier qualification for growing portfolios. And if one property is slightly underperforming, the stronger assets can offset the weaker ones. And this flexibility is often not available with individual conventional loans. There's potential for higher leverage with blended cash flow, but some lenders allow higher leverage across a stabilized portfolio versus a single asset financing. But it's really based on income is the point. Streamlined refinancing. Refinancing 8 properties at once can reduce friction versus managing staggered loan maturities. One loan, one payment, pretty cool. 5, it's better for BRRRR operators. So if you're recycling capital frequently, portfolio structuring can simplify your repositioning. So let's look at some of the cons of portfolio blanket loans, and that's something that most people don't talk about. And here's the part that lenders skip. So one, you have cross-collateralization risk. With all properties being tied together, if one asset struggles, the entire portfolio is on the hook. And you cannot sell or easily sell one property unless the lender allows a partial release. And sometimes they want a bigger percentage to release that property. So that's a real risk. 2 is balloon risk. Many blanket loans mature in 5 years. 5 to 10 years. But if rates rise or debt yields tighten, refinancing could require additional equity at that point. And 3, there's less flexibility to sell individual properties. And without a pre-negotiated partial release provision, you could be locked in. Most people will work with you, but it's something you have to be aware of. And that limits optionality, and optionality equals value in real estate. 4 is portfolio contagion. So if you have one vacancy spike or one insurance issue or one tax jump and your DSCR drops across the pool, you're going to lose flexibility for the group. And 5 is it's not always the cheapest option. Sometimes separate DSCR loans or agency-style financing provide better long-term economics with full 30-year fixed rates. The point is, structure is better than the headline rate. And when does a blanket loan make sense? Well, it works best when you've got a stabilized portfolio or investors plan to hold for a medium term and cash flow is consistent and you have a good reserve position and you have a clear refinance or exit strategy. Now, where it may not make sense is if you plan to sell properties off individually and soon, if you're highly leveraged, or if you lack liquidity and reserves, or if you rely heavily on short-term appreciation as your play. So portfolio strategy matters more than the product itself. And in markets like Houston, Katy, and Fulshire, where values can move and insurance tax volatility exists, your financing structure must protect your equity. Now, a blanket loan can be a powerful scaling tool, but it must be structured properly. So remember, partial release clauses is a big question to ask. Your extension options. You want to have a strong DSCR cushion. You want to define your exit timing. And you want conservative leverage. And this is where brokerage matters. Banks offer one balance sheet, and we structure across hundreds of lenders is the point. So here's the final thought for the day. Blanket loans are neither good nor bad. They are a tool and a useful one. But tools only work when aligned properly with your strategy. And if you own multiple rental properties and want to evaluate whether a portfolio blanket loan is going to improve your leverage position, let's run the numbers properly. You can visit my website, billrapponline.com, to figure out how to get a hold of me. Love to talk to you more. Have a good day.